Right, thank you for joining this morning for what is going to be a brief introduction to pre-year end planning. The purpose of the webinar is just to highlight why it's important for a business to carry out a review ahead of the financial year end, rather than wait until after it's finished. And then we'll look at a few ways to mitigate some tax liabilities, which are heavy at the minute. So why do we perform pre-year end planning? Well, it helps us to understand where we are with tax, profits, drawings and cash flow. If your planning consists of discussing the year-end accounts with your accountant once your accounts have been prepared, you're not really planning, are you? You're just reacting. So what we like to do, we like to meet 4 to 10 weeks before a financial year end and use some interim figures to project likely profits for the year and estimate what the tax liability would be. And it also allows us to project personal tax bills based on what you've drawn out and how your company's performing and what salaries you've taken, etc. So moving down, since the corporation tax bill isn't due until 9 months after the end of a company's financial year, the first benefit of a pre-year meeting is to give plenty of advance warning of expected liabilities. It's better to know what you need to pay now rather than finding out a couple of months before it's due. Some planning opportunities are missed if they're not discussed within the financial year. For a lot of things, more can be done pre-year end than post-year end. Setting a timetable helps us to ensure that the year-end process runs smoothly. It may be that you have external bank funding that need financial information by a specific date. You may need to prepare tenders, and having accurate information will assist. And it may even just be to improve your credit rating, which we'll come on to. There's several common ways of mitigating tax liabilities, which we'll come on to. But as I mentioned earlier, some need implementing ahead of the year end. Reviewing the timing of dividends can help to make the best use of tax bands and available allowances. And it also helps to ensure that we don't get tagged by other taxes, such as the high income child benefit charge. So we can move dividends between tax years and keep income below that 50,000 threshold where possible, of course. And finally, reviewing your financial performance based on previous years will help you to improve areas of your business that aren't fully being exploited or aren't performing that well. So it gives you a chance to look at your business as a whole. It's corporation tax. As you can see there, profit declared in the final accounts is liable to corporation tax. I'm sure you're all aware. That rate is currently 19%, and the tax falls due 9 months after the end of the year. Corporation tax rates are actually rising from 19 to 25% with effect from the 1st of April 23, which will make planning even more important. However, the 19% is going to continue for companies that have profits less than £50,000, and then there's what we call a marginal rate for profits there up to £250,000. Once you hit the £250,000, it's 25% corporation tax rate. So the first step of planning is to estimate what your tax liability might be. This is done by taking your current management accounts, which may cover 9, 10, 11 months maybe, and projecting your likely level of profit for the whole year, which the easiest way to do is just to simply extrapolate the profit. But of course, if you're a seasonal business where most of the trade is in summer or winter, you might need to make an adjustment for that. Once you've got your taxable profit, you multiply it by 19%, and this will give you an indication of the likely level of your corporation tax liability, and it will allow you to consider what options are available to mitigate some of that tax. If you've previously made losses which haven't been utilised, these can be used to reduce your level of taxable profits. So if you're a startup and you've got losses last year that haven't been relieved, they can be offset against your current year corporation tax liability. So you may need to ask your accountant or ourselves what if there is anything to use this year. And the bottom point there, when your company's taxable profit exceeds 1.5 million, if you're going to do the same again in year 2, so the next year, you need to be making quarterly payments on account for your corporation tax. If you're not doing that, you get charged interest from quarter 1 and Q2, etc., for any amounts that haven't been paid. So it's important that if you think you're going to trigger that, you speak to your accountant and we'll calculate taxable profits for you so that you can make those payments on time. Just a little warning first, there's still plenty of, shall we say, shady tax schemes that are being advertised. The kinds you've seen in the press in the past, where Jimmy Carr and Chris Miles and big celebrities have put money into loss-making schemes to try and avoid paying tax. Any tax planning that is deemed to be abusive continues to be challenged by HMRC. But anything that we're mentioning in this webinar today, they are all statutory reliefs, which can be used as the government intended, which is to assist your businesses in improving cash flow for growth. If you can avoid paying tax and invest the money, great. The first step is capital allowances. So when you're buying a capital asset, it might be a van, it might be plant and machinery, computers, etc., and you're depreciating them, the depreciation of fixed assets, which is charged to your profit and loss account, isn't allowed as a deduction in computing taxable profits. Instead, you receive something called a capital allowance, which is given at rates prescribed by UK tax legislation. In the budget earlier this year, the March budget, the Chancellor announced a new super deduction for investment in new plant machinery and equipment, which is essentially an enhanced form of capital allowances, which we'll look at in more detail on the next slide. And for those of you who are aware of it, annual investment allowance remains at £1 million for any expenditure that doesn't qualify for the super deduction. So anything that you buy in second hand, you can still get 100% relief on, up to £1 million. So the super deduction. So the super deduction was introduced to keep the economy moving. As I mentioned earlier, corporation tax rates are set to rise to 25%. So the government didn't want businesses to delay capital expenditure until then. So they've effectively increased the allowance on new equipment to generate the 25% saving now. The super deduction will end in March 2023, which is when the corporation tax increases. The equipment that is allowable for a super deduction, it must be new, it must be unused, and it must be purchased for the trade. Integral features of a building, for example, heating systems, boilers, etc., the saving is actually only £95 per £1,000 of expenditure, but that is up from the £80 that you currently get. And at the bottom there is no cap on the amount of expenditure that qualifies for the super deduction. So you can spend what you like on getting the extra relief. But what I will say though is don't just buy assets for the sake of it. If you need to replace a van or you need to replace a piece of machinery or equipment or your IT's out there, that's great. But if not, cash is still king, so just keep the cash. Cars. So in recent years, tax on company cars has made them extremely unattractive to employees and employers. But this isn't the case with electric cars. Newly registered fully electric cars qualify for 100% relief, which makes them attractive to employers. And the benefit in kind on these electric cars is only currently 1% of the list price, which is rising to 2% of the list price on 6th of April. So they're actually a relatively cheap way, apart from buying the car, obviously, they're a relatively cheap way of providing a benefit to your employees. And finally, cars, they can be charged at the workplace without a benefit in kind arising. So where you used to get fuel charge, if your employer paid for your petrol, there's no such charge for the electric vehicles. So a company can make specific provisions against a number of things to reduce tax. So the first one there is stock. You can make a provision against any slow-moving, damaged or obsolete stock, but just be aware that a general provision isn't allowed against as a tax deduction. So you can't just say, for example, that maybe 10% of your stock is overvalued. Stock needs to be valued on a line-by-line basis if product A is good and product B needs writing down, great, but you can't just apply a blanket approach. Same with the debtors ledger, to be honest. The debtors ledger should be reviewed in detail so that all bad debts are provided for. And where a provision is to be made, it's important that there's evidence available to prove that the debt is bad at the balance sheet date and that the issue didn't arise afterwards. So if you've got a customer that suddenly went bust 2 months after your year end, but you've kept supplying them since, and then they've paid a little bit, but there's a little debt outstanding, you shouldn't really provide for it, because at your year end date, it was a good debt, they just haven't paid. It may be possible to make a provision for staff bonuses to be paid in the following year, which brings forward the tax relief on that payment. But for such a provision to be allowable, it's got to be possible to establish that the liability to make that payment existed at the balance sheet date. Again, it may be in a contract, it may be expected, as in it's done every year, but it must be the reason must exist at your year end. Payment of those bonuses must then be made within 9 months of the period. Otherwise, they'll only be deductible in the accounting period in which they're paid. So if your year ends December and you accrue a bonus, but you don't pay it till October, it's not allowable in December accounts. It goes into the following year. So it's really important that they're paid on time. Pension contributions. Employers receive tax relief on pension contributions, but only up to £40,000 for the current tax year per employee. So this amount is known as the annual allowance, and any contributions made over this limit are taxed at the higher rate of your employment. It is possible to contribute more into the current year if you have unused allowances from the previous 3 tax years, and you'd still get tax relief. You just need to be in a pension scheme at that for those 3 years. So we're now in 2021. So if you've not made contributions in 2020 or 2019 or 2018, you could in theory put in up to £40,000 for each of those years to obtain tax relief. So you could put in 160 into your pension and obtain 19% tax relief, it would obviously be a big saving. And like a few of the other provisions, tax relief is only given for contributions actually paid in the year, rather than the figure provided for in the accounts. So in simple terms, what that means is you can't accrue pension contributions. 6 months down the line, you can't be thinking, oh, actually, we've got a really big tax bill. Why don't we put 20,000 into a pension and reduce it? You can't do that. It has to have been paid by your balance sheet date, which again makes the planning more important. So the downside of everything we've covered so far is that they all impact on the balance sheet. They're all involved in reducing profit, which is reducing your reserves, which is weakening your balance sheet. That's not the case for research and development tax relief. This is a government incentive introduced back in 2000, where tried to encourage UK businesses to try to evolve and create new technology and not just follow what's gone before. So you can see that for every £1 spent, you get tax relief of 43.7%. So if you spent £1,000 on research and development, you will be able to deduct £2,300 off your taxable profit of your company. So that's how you get to the 43%. What can be claimed? So there's a lot of costs that can be claimed, but they all must be associated to the activity that's taken place. So you've got obvious ones such as staff wages and related costs. You may have paid subcontractors to do some work, some research into a project you're trying to do, maybe external workers. You've probably used materials to create prototypes or create, just to testing, obviously. There may be software licensing, you may, depending on the industry, there may be clinical volunteers. So there is a very wide net of what you can actually claim back. There are certain rules. So if you think you may be involved in research and development in any way, shape or form, just contact us and we'll come and see you and have a run through of your process and see what you think you've done, and we'll let you know if you think you can claim. financial presentation. So we've looked at ways to reduce your tax bill, and we've mentioned potentially weakening your balance sheet. But the credit rating is critically important at the minute, particularly given the last 2 years that we've gone through. So in the absence of recent financial information, credit reference agencies tend to take a very prudent view and assign a high risk of failure to what were previously successful businesses. So if you're a new company or your latest accounts show significant improvement in your trading performance, you should aim to file your accounts as soon as possible, just to get them on the record, to get your credit rating up. Other ways to do it, where cash flow allows, you could pay your creditors early to improve your what we call the quick ratio. And the quick ratio simply measures a company's capacity to pay its current liabilities without its needing to sell its stock or obtain additional funding. So basically, can you continue simply? On the other hand, though, it may be beneficial to delay paying creditors. So if you don't have a lot of cash in the bank and you make your payments to your creditors at the end of the month, simply by delaying it until the start of the next month, you're leaving more cash sat on your balance sheet, which credit reference agencies like. So whilst the overall net effect is the same, your net assets are the same, the actual fact that it's cash sat there and not lower creditors is a tick. And where some of you have bank borrowings, where you have covenants in place, it's better to test them as soon as possible. So if you are in breach of any, you've got a little bit of time to try and find a solution. Is there anything you can do with your creditors, with your stock, etc., to make you meet your covenant and get you back on track? So we've looked at the past, now we'll have a look forward. Making tax digital it's been in the news for a long time because it keeps being delayed and pushed further down the line, but it's actually starting to kick in now, and it seems set that it's going to appear on the horizon anytime soon. So currently, MTD for VAT is to be extended to all VAT registered businesses. So currently you only have to do it if you're above the VAT threshold. That's going to be scrapped. So if you're turning over £40,000, you're going to have to register for MTD, which is where your VAT returns are submitted electronically or through software rather than being input manually onto the HMRC's website. And in terms of individuals, quarterly updates are going to have to be submitted to HMRC from the 6th of April 24. So where now we do an annual tax return, which needs to be filed by the 31st of January every year and paid, there's going to be reporting requirements for every quarter. So the first quarter will be the 5th of July 24, the second one October, then January, and then April. And then there'll be a catch up. So you'll file your 5th return will be consolidating the 4 quarterlies and confirming your tax liability and making you make the payment. But why this is important is it will soon become impossible to what we call backdating dividends. You can't say, well, on the 6th of April last year, I will have taken a dividend. You have to have documented it because it will have to have been on your 5th of July quarterly return. So the reporting requirements are getting much more onerous on individuals and businesses. So that's it for this quick introduction. I hope it's given you a few tips or a few things to look for. Our contact details are up on screen. I've just put my email address on. We obviously have specialists in all the different areas. We've got one of our directors, Ben Smith, is the R&D expert. So if there's anything you want to discuss or you've got any questions, do feel free to email me or contact us. And there's a little map there for those of you that don't know where we are. So I'll open it up to questions. If anybody has any questions, if you just want to put them in the chat box or unmute yourselves if you're able to, I don't mind. Right, there's nothing through coming through, so we'll call that a day. So thank you very much for joining us. And like I say, if you want to call or email, please feel free.